all that applies to risk management as a trader. So first off, there are two types of risk management. We have the capital risk management and percentage risk management. So when it comes to the capital risk management, we are having an initial capital and we're splitting it into smaller amounts or smaller segments, right? So mostly we use 20 folds, right? So whatever amount you have divided by 20, then that gives you different amount you use per trades. And which type of trades do we use this on? We use this on long-term sports trades, right? So when we see a project launch or we spot a project that has already launched and we want to buy, for the long run, just like you want to buy Ripple when I called it or buy any of those long-term trades I called back in September and August, you would have used this model for it, right? So ideally, we also use dollar cost averaging. So dollar cost averaging is a system where from our entry price, we split it, 10%. So we split it just 5%. So we go like 5% from our entry downwards, right? And then we take the first entry at the current price, and then at 50% of that is more like negative 2.5%, we place the second entry, and probably at 5% to place the next entry, right? So you can do all of this on Bybit using the sports trading, using limits on sports trading, right? You can perform this dollar cost averaging model on there.
Margin is the money that is deducted for you to place a trade. So it is not actually a loss, it is just a collateral. Afterwards, the trade goes in profit, it will be returned back to you.
Now, if you have a lower leverage, right? If you have a lower leverage, what will happen is that there would require a larger amount of margin for you to open the trade. But if you have a higher leverage, they'll require a lower margin. So that's just the relationship between margin and leverage. So these two types of margins have something in common, right? So for isolated margin, let's say you were to execute a trade on isolated margin. What happened is that there is a liquidation price, right? So whenever the market goes and hits the liquidation price, your trade would close and you will lose your margin, right? So that margin which you actually placed to enter the trade will be lost. So that's just what goes on the liquidation account. For you to enter the trade will be lost. Then the next thing is your stop loss and take profit are also dependent on your liquidation price. So it means you can place your stop loss and TP, but if your liquidation price is before or even above the right word is before. If the liquidation price is before your take profit or your SL, what will happen is that price will hit the liquidation price and the trade will close without even being invalidated by hitting your stop loss or getting to your TP. So to risks, right, that quantity when you're opening the trade, right, will determine the margin. So let's say you decide to use 5% of your account, and if 5% can only get maybe 10 quantity or 20 quantity, right, alongside with leverage, if the trade was to hit your liquidation price, only that 5% of your account will be lost. That's just how margin works, isolated margin works, right? The 95% of your account will still be there. It's a bit safe. But this becomes difficult for us as traders because if we're trading on the higher time frame, right? We're trading on a higher time frame where we have a bigger stop loss. So liquidation price has a fixed relationship with the leverage. So what it means is that as your leverage becomes bigger, your liquidation price becomes very much closer to your entry price. That's one rule. And then as your leverage becomes smaller, your liquidation price becomes farther away from your entry price. So if we are going to be using a certain leverage, right, a very high leverage, we're going to have a very small buffer for our liquidation price before price could, just retrace and just take us out of the trade. And that is number one, right? If you use isolated margin and you're on the higher time frame with a big leverage, you would most likely get stopped out of the trade even before the price goes to hit your stop loss because of your liquidation price is very much close to your entry price, while your stop loss is very much farther away from your entry price, and that doesn't just work. Price needs a good amount of room to breathe and you get stopped out. So for cross margin, this is the different area here, right? So I would recommend people to use cross margin, but you must use cross margin with stop loss, right? You must use it with stop loss. You technically don't know the level before you enter the trade. You need to know the level of which, if it was to hit, the trade becomes invalidated and you shouldn't be in the trade anymore, right? So what's the benefit of cross margin? It is independent of liquidation price, right? So it doesn't care about liquidation price, and that means you don't need to worry about at what price do you get liquidated and on all this kind of stuff. There is a liquidation price actually, but when price gets to the liquidation price, it will not close your trade. It will continue running, right? So that's just the difference. So the only time your trade gets to be closed is if it hits your stop loss or TP. Unlike here where price doesn't need to get to your stop loss or TP. If it just touches your liquidation price, the trade is over, right? So your liquidation price on isolated has to be far above or below your liquidation, your stop loss and TP for you to trade correctly. And knowing the fixed rule is that for your liquidation price is dependent on your leverage and it's fixed, right? Liquidation price is fixed. You cannot move it, right? So on 10x leverage, the liquidation price is just simply your entry minus, you know, the entry divided by your leverage. So let's say your entry price is $2 minus your entry price divided by your leverage. So if your entry price is $2 and your leverage is 10x, right? So if we say 2 minus 2 divided by 10, we're going to get 2 minus 0.2, right? So 2 minus 0.2 is giving us a $1.8 as our price. So that means the liquidation price is $1.8 for a 10x leverage. Now, if we do the same thing for a 100x leverage, we say 2 minus 2 is being our entry, right? And our leverage is 100. 2 minus 2 divided by 100. We already know that 2 divided by 100 is going to give us 0.02, right? And 2 minus 0.02 is equals to 1.98. So we can see that the difference between 1.98, right, and 1.8, if you were to compare the difference, you can see the gap is is much closer to our entry price on a 100x leverage and much farther from our entry price on a 10x leverage. So that already tells you that the higher your leverage, the closer your liquidation price is. So it means the closer you will get stopped out of the trade. And that margin which you place, maybe 5%, remember according to the risk management rule, right? Right? 1 hour, 2 hour, right? And the entry is most likely going to be on 15 minutes or even 5 minutes, right? So the stop loss is going to be very smaller. So it means you can actually use a bigger leverage there, right? It doesn't, regardless of whether it's isolated or cross, you would go away scot free with that. But on a swing trade, which you are entering the trade on probably 4 hour time frame or the daily time frame with a very big stop loss, you shouldn't use a high leverage. And even if you want to use a high leverage, remember for isolated, right, your liquidation price, it must below your account, right? That is just how margin works. So this is the basic risk management. Let's see if this app has opened for us to view what's going on here.
Term trades, mostly on sports, we know we're going to be using 5% of our initial capital, right? And what that means is if we don't have an optimal entry, like we're not buying it pre-sales or we don't have a very good entry, we want to use DCA. But ideally, I recommend using DCA every time, regardless of optimal entry or not. It's just if you don't have an optimal entry, you'll DCA into 5 steps, right? You just use 1% on each level. But if you have a very good entry, then you want to DCA in just 2 steps, right? Being 2.5% on each of your entries. So at current market price, you use 2.5, and then you set a limit at your second market price with the 2.5. So what that simply means is, let's say we were into Bitcoin, right? When Bitcoin did this crash, let's go on the 4 hour time frame. So we'll just see the crash, right? When the market did this pullback or liquidation, right? So as we can see, price was going bullishly, and then we had this huge bearish candle that just came and liquidated everyone who was buying in these levels, right?
So if you were looking to take a swing trade off of Bitcoin, right? The entry would have been, excuse me, the entry would have been at the retest of this level. So you see this rejection week that happened here. Our entry will be when price came back to retest it. That is what is going on right here. So how would we have even entered the trade? How would we have known the right levels? The truth is we don't really need to know the exact right levels. We just need to know from which areas where the market is more likely going to respect. And since we are aware of this rejection level here, all we have to do is know that from once price gets to this level, right, we just want to get our minus 5% from there and we can DCA with it, right? So from here to thereabouts, yeah, right? So ideally, what I'll do is I'll consider the top as my current market price. I'll enter 2.5 at CMP, that's current market price. I'll place 2.5% from my 5% here, and then the other one I'll place 2.5 here. So in this case scenario, as you can see, right, will only have been triggered on the 2.5, and the other one down here would not have been triggered on it. So that is basically how the DCA method works on sports when you're looking to like long for the long run, right? Now, yeah, we don't need to worry about leverage, right? Because we're buying without leverage, we're buying and we're owning the assets, right? So, um, but there's restrictions, right? There's quantity restrictions. There's most couple of times there will be quantity restrictions. But let's go on now to the next. So the next thing we have on here is percentage risk management, right? So we know that we use this for day trading, regular day trading, right? So, and then we also use it for meme trading, right? So we'll talk about memes later on, right? So here we have memes. So we'll talk about it. We'll get it. We'll get there. So, but right now, percentage trading is for day trading and meme trading. So we use single trade entry, right? A lot of our entries are just one entry. Then we also have swing trades and meme trading alpha. So when we talk about meme trades, we'll talk about how to go about risking 1% on meme trades and how to go about risking 5% on meme trades as well. But for now, let's trash out day trading and swing trading on futures, right? So once again, for you to get to here, come to trades, hover around trades, go to futures, and from futures, you will be directed to this place. What we can get to see on futures, let's say we're interested in taking this particular trade from this level. We're anticipating that if price comes here, we buy and we hold for 104,000, right? So what we have is our entry and our stop loss. So if you look at this time frame, it's 30 minutes. It's very much close to 15 minutes. So this is a day trade, right? This is a trade that we enter. It could be done in 8 days, 2 days, or even 3 days, right? Or it just goes hit our stop loss and does it. So those are day trades. We are not holding this for like 6 months or 1 year or any of those kind of stuff, right? And it's not also a swing trade. So in situations like this, right, when we have to now know how does isolated and cross margin comes to play in this type of trading, right? So we have isolated, we have cross margin. So on isolated, if we were to use isolated, right, this is what is going to happen, right? So as soon as we enter this trade at this price, right, and then let's look at our stop loss. Our stop loss is 1.29% from this level. From what is the entry price? 99,841. From 99,841, our stop loss is negative 1.29%, which is 98,551, right? Now for our leverage is 100x. So if we use a 100x leverage, right, let's come to the calculate. Okay, so let me use this one because I want to show you guys the exact level of where our liquidation price will be. Remember, when we come to using isolated, we have to take note of our liquidation price. So the thing that is very important here is I want to make sure that my liquidation price is not within my stop loss, right? It should not be within this 99.84 to 98.55 It should be below it. If not, if my liquidation price is within it, then If price was to retrace right within this level, just range for a while, it's going to hit my liquidation price, and I'll be taken out of this trade in a loss. So how do we confirm our liquidation price, right? You just, the entry being 99,841 minus, you know, our entry, this entry price divided by 100. So if we were to just, let's divide this by 100 so that we'll know the value, right? That is 99, it's 998, right? So we have 99,841 minus 99.841, right? So our liquidation price is at what? 9880 and 98,841. So let's just put a line on that level, right? Let's put a line on that level. Let's see where it falls at. So I will place this, and then let me see, where does this line falls at? So it, if you recall, it's at 98. Let me just pull that up. 98. Can I even copy? Let's see if I can copy and paste. Okay, I can. Yeah. So this is it. 98.84. This is where the liquidation price is. So what, guys, what do we see? We see that our liquidation price is within our stop loss, right? So this is one thing we never want to see in our trading. If we get to see this, we are going to, you get to see that price will not even reach our stop loss. By the time the market just moves bearishly for a while, let's just say it calms down a bit, right? If price was to just come down like this, and touch this line, this blue line, right, our trade will close in a loss, and then price could still go up and hit our TP, and we'll close in a loss. Why did we close in a loss? It's because it has hit our liquidation price. So this is what occurs when you use isolated. And if you recall from the examples we've gone over, we stated that in isolated margin, right, it is dependent on liquidation price, right? So your stop loss and take profits are also dependent on liquidation price. So if price was to hit our liquidation price, first off, we would be out of this trade in a loss. So how can we fix this? The solution to this problem is to reduce our leverage, right? Is to reduce our leverage. So let's say we reduce it to 10. Because when you want to use a high leverage, you want to have high precision. It means that if price was to tap this level, let's just say for you to use a very high leverage, you believe that if price is to come down and tap this level, it will just go up immediately. It will not, hover, it will not range, it will not deep, it will not do any of those stuff. It will go in profit immediately. So if you cannot assure yourself of doing something like that, please avoid using super high leverage, right? If you don't, and guess what? None of us have that information. Me, I don't have that information, right? So I won't lie to you that I have such an information. You need to give your trade room to breathe. Just like President Tinubu will say, allow the poor breathe. Allow your trade to breathe, right? Don't suffocate it. Don't put your stop loss too close, and don't go and use a high leverage that wouldn't give you a very tight liquidation price as well, right? So that is just a solution. I hope this is understandable, because oh my god. Now let's look at what occurs if we use a 10x leverage, right? So for a 10x leverage, remember, this is where, let me just write it, 100x leverage. This is for our 100x leverage, right? So let's see what happens when we want to use a 10x leverage. Let's pull up our calculator one more time. So the current price is of the entry we want to use is where? It's currently at 99,832, right? So on our calculator, we have 99,832 divided by 10. Remember, the leverage is 10, so we divide it by 10. We're getting 9,983, right? So we simply do 99,832 minus 9,983. 3.2. What would this give us? This will give us a liquidation price of 89,848. This sounds good, right? Just think about it. Our stop loss is at where? 98,607. Our liquidation price using a 10x leverage is where? 89,848. So if we were to do that, for us to even see that liquidation price on the chart, this is what we have to do, right? This is what we have to do. We have to zoom in, right? And then let's bring out the stool, right? And then I'll place it down here. I'll look for 86,000, right? 89,000. So let me copy this, and so this is for a 10x leverage, right? This is where our liquidation price would be at. Yo, can you see how far it is from our stop loss? Remember, for your stop loss to be respected in an isolated margin, your liquidation price must be far away from it. So all I've been telling you guys all this while is that with a higher leverage, your liquidation price is very much closer to your entry. So you see where our entry is at. See where our liquidation price is even within our stop loss. But guess what? If our liquidation price is down here on a 10x leverage, we are safe. But are we safe if we want to be a swing trader? Let's see. If we want to be a swing trader who wants to take a trade on the 4-hour time frame, are we safe with a 10x leverage on isolated? Is this liquidation price good for swing trading? Right, let's confirm. Is a 10x leverage a good liquidation price for swing trading? So this already tells you that using a 100x leverage is not good if you want to be a swing trader, right? No matter the account size you have, you can never use a 100x leverage as a swing trader. It doesn't make sense because you see, you can't swing trade. Okay, let's go on. Let's see where would be our liquidation price if we want to. Let's say we want to be a swing trader, right? So remember, this swing trade I called on here. I stated this swing level, right? So we're on the 4-hour time frame. I said we would have to use 5% for our swing trades, right? That's the entry and then our second entry, while our stop loss would be about 10% away. So let's see how that works, right? So let's rebuild that exact same trade on here. So we would be having this as our key level, right? And then for a swing trade, we want to have our stop loss about 10% from our entry, right? So let's see if on a 10x leverage that would keep us safe. So 10% from our entry, right, for a swing trade would be at 86k, right? So now here's what I would do, right? I'll bring both of this together, right? And let's start. So let me also get rid of these ones because we're no longer using them, right? We're no longer using any of this. We're now talking about swing trading. So what's going to happen is we're going to have two entries, right? From here all the way to... So I want to just drag this one down by 10%. So how I know it's 10%, I'm looking at here, 9.62. So this is 10%, right? So all I want to do is I want to have two entries for this buy trade, and also at the 5%, right? That is about all the way down to 10%, right? I would want to take the second trade. So I want to place a limit. Paraventure price was to get down here. I'll take it. So if you recall the DCA strategy says that you're at CMP, you place about half of your risks or 1% of your risks at CMP, and then at when price goes from 1%, that is at this level, 1% to like -2%, you place another 1%. When price goes from that -2% to -4%, you place another 1% risk. When price goes from that -2%, 4% to -6%, you place on that 1% risk all the way to -8%, right? So that's how we do the DCA, right? and at the end of the day we get to have good entries. So a couple of times, not when you are doing this here, it doesn't mean that you would have all your entries triggered, right? Some entries might not get triggered, but in the long run, this is how you'll be safe whether the market is going downwards or going upwards, right? But if you have an optimal entry, that's like, this is an optimal level. After liquidation, you're entering the trade, right? You don't want to use 1%. We're risking a total of 5% on that particular trade idea or that particular asset at the moment, right? But if you have a good entry, you don't want to break it down by 1% on 5 different entries. You want to just use 2 entries, 2.5 at CMP, and then about 2.5 at 5%, right? That kind of stuff. So this ideally is the trade, right? So for now, we have been triggered on the first one at 2.5, right? And then the other one, which is about 5%, did not get triggered. So in this case, we want to understand one important factor, that is liquidation price. How does liquidation price affect this trade? If we were to use a 100x leverage on this trade, right, this swing trade, what would be our liquidation price? Right, as a future trader, let's see what that would be. What would be our liquidation price as a future trader? Let's see what that would be. So the entry which we have here is 96,809. So all we want to do is check 96,809 divided by 100, right? Because that is, oops, did I use? So I want to check 96,809 divided by 100. That will be 968, right? So we'll have 968. So all we want to do now is do a subtraction, right? Being 96,809 minus 968. That will give us 95,841. So we would take our stop loss. So let me just copy this real quick. For our 100x liquidation, right? So if we are to be using 100x liquidation, let's paste this. So what do you see? You see how close it is to the entry price. So as a swing trader, let's just ask ourselves the reality of what this means, right? You are a swing trader, you went and used 100x leverage on your trade. This will be your liquidation price. So as soon as you enter the trade, you get liquidated immediately. So if you were risking 5% of your account, 5% has already disappeared, right? So, or if you were risking what's it called? You enter 2.5% here. Before, as soon as price just hits, comes down a bit, it has already liquidated. And soon you say, trader, there I've been liquidated from this trade and it's going in my direction. I don't know this. I don't understand crypto. This is what is going on, guys. This is what is going on. Now let's see. How about if we were to use a 10x leverage? Once more, we would get our entry price. Our entry price was 96,000. I didn't even know how to zoom on my MacBook, but okay, 96,643, right? So let's just bring out that level, 96,000, right? Guys, give me 1 second. Let me just confirm this levels is correct. Yeah, 96,629. So let's bring that up. 96,643 minus, if we were to use a 10x leverage, this would just be 96. That is 96,643 divided by 10, which would give us 9,664. So minus 9,664.3, right? So this will be about 86,978. So with this, for our 10x leverage, right, we just want to get it to 86,354. So let me just paste the value, right? Being this, let's paste that into there. It's 6,000. So, guys, what can you see? You can see how it tried, but it came pretty much close, right? So for a 10x leverage, it's what you can see is that it's very much close to the stop loss, right? It's still within the stop loss, right? But it's pretty much close because our stop loss is meant to be perfectly on the 10%, and is because a 10x leverage is actually just negative 10%, and a 100x leverage is just simply negative 1%, right? That's just all it means. So you guys can now see how all of these factors affects your trading. So that's why when you're swing trading, you want to use lower leverage regardless of your account size. So if you come in with $1 million or $100 million and you go and use 100x leverage, what will happen is that you will lose that money. So there's no money too big to be lost and no money too small to be lost as well when it comes to leverage. So on swing trades, we use smaller leverage because we're having bigger stop loss, and the only thing that can accommodate for the movement of price within our trading level is a smaller leverage. But what about when we change over to um, cross margin, right? So let's see why using cross margin. What happens when we're using cross margin? Let's see. So when we're using cross margin, the difference, if you recall, let's just go back on here and let's refresh our memory. On cross margin, it is independent of liquidation price. So there is a liquidation price very much the same as you would, on a 100x leverage, the same liquidation price which you have, which is negative 1% from entry for 100x leverage, and for a 10x leverage, which is just negative 10% from entry, right? Is also applicable on cross margin. But the difference there is that if price was to hit that liquidation price, it will not close the trade, right? That's just what happens on cross margin. But on isolated margin, once it hits your liquidation price, that is dependent on the leverage size which you're using, it will close the trade, right? So what happens is that in cross margin, you must use your stop loss and take profits, right? Because if you don't have a stop loss, it will keep going in a loss until it wipes out your whole balance, right? It will keep going in a loss until it wipes out your whole balance or reverse in profits. So that's what happens on cross margin. That's why we must use stop loss on cross margin. So the best place to actually trade properly, that is the way I know how to trade as a forex trader. The type of trading I'm used to is using cross margin, right? But you must use your stop loss and CP. So that is why we call this risk management, because risks can only be managed if you can determine a predetermined loss before entering a trade, right? So it is, I'm going to look $10 from my $1,000 before I enter this trade, and at the end of the day, if I was to take a loss, I'm only going to lose that $10. That is risk management. Then if the trade goes in profit, you get to make $50, or that is if it's a 1:5 hour or a 1:4 hour, and that is the end of risk management, guys. Yo, I hope you guys got value out of this.